Good evening and welcome to another rollicking and rousing edition of Bond Squad After Hours. I'm your host, Tom Byrne, Director of Fixed Income at Wealth Strategies and Management. And before we proceed, let's get the disclaimers out of the way to keep compliance happy. Investment advice is offered through Private Advisor Group, a registered investment advisor. WS&M LLC and PAG are separate entities. The opinions voiced in this material offer general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced here is historical and there is no guarantee of future results. And we cannot stress that disclaimer strongly enough because there is no one investment that's good for everyone, and so we do not attempt to make blanket recommendations on this program because that would be, well, irresponsible. So for more than a year, I've been writing that the economy might be getting near the peak. When we saw these strong GDP numbers in Q2 and Q3 of last year, that felt a little peak-ish, if that's a word. And, going into this year, yes, we had another slow economy during the winter, but something felt differently. And I opined back at this time last year, and by the way, this is the 1-year anniversary of Bond Squad After Hours. I opined last year that the decline in oil prices might do more harm or as much harm as good because of the jobs it creates versus the jobs it destroys. And that's played out somewhat. Meanwhile, we've had the commodities market crumble, and that's taken down many emerging economies, which in spite of years and years of economic vitality caused by resulting from a strong commodities market, they did nothing, and for the most part, to restructure or diversify their economies. So now, as a gentleman from PENCO, Pacific Alternative Asset Management, said this morning on CNBC, Sam Dietrich, I believe his name was, that EM's trading partners are mostly EM. So, one sneezes, they all catch a cold, and that's what I said, not what he said. So, we're in a situation now where it does appear that we are later in the business cycle, in the economic cycle, than many economists believed coming into this year. Why did they not believe that? Well, because consumer sentiment was higher than it usually is near the end of a business cycle. We haven't seen inflation or growth run at levels normally seen at the peak of an economic cycle, never mind near late cycle. So it was assumed, and you should never assume, what happens to you and me. It was assumed that we still had that other leg to go. We had another leg in the recovery to go because we have to get there. Remember, we don't have to do anything. The economic growth, inflation, consumer sentiment, retail sales is all dependent on a host of factors, including consumer confidence, wages, credit conditions, not just interest rates, but credit availability. And if you want to talk interest rates, well, and I'll share this chart directly. Compliance doesn't want me to post charts as far as I know. But our real household incomes in the U.S. are about the same in real terms again as they were in '96. So what we have here is incomes in real terms went down since the financial crisis. So even with lower rates versus household income still might be not especially low at this point, not as low as an absolute yield of the 10-year, which is the benchmark for 30-year mortgages. As he speaks now, sits about 1.97%. It was just last month that I heard pundits come on television saying, "Oh, the bond market doesn't understand. We'll be getting closer to 3% by the end of the year." The long bond, the 30-year government bond, might not get close to 3% again by the end of the year. That remains to be seen. And adding credence to my view that we are, in fact, heading towards late cycle, or if not turning into late cycle, well, we have not only retail sales, we have employment that's slacked off. Job growth is now trending below 150 the last 2 months, 150,000. And we had the Fed's Beige Book today. And the Fed's Beige Book indicated that the U.S. economy has expanded modestly, not even moderately, but modestly since mid-August. And it shows that outside of very specialized jobs, high-skilled workers, that wage growth is really not picking up, with the exception of some areas of the country that forced minimum wages up. That's probably not the best way that you want wage growth, because if you force those wages up and you don't get a revenue growth for those companies, hiring slows down, layoffs pick up, companies struggle, capex slows down. It's just not a good. When the government gets involved and tries to force outcomes, and I don't care what political bent you are, it has an effect on the economy, and it's usually anti-growth. You can argue that it makes things fairer. I won't argue that, but some people will. But it's not exactly pro-growth, at least from a GDP standpoint. So that's what's going on. So if you had to ask me, where in the economic cycle are we? All right. Well, let's say it's pretty much a wave, right? So you have a peak, then you have deceleration, contraction and bottoming, then you have growth, then we peak again. It keeps going on and on. Well, I believe that we are just a little bit past peak, meaning that we are starting to get into the deceleration mode. This does not mean we're getting into the contraction mode. Bond Squad runs on Duncan. We're not getting into the contraction mode. I think we are resetting. So in other words, what was considered subpar economic performance might have been the outperformance in this cycle, and the real or the neutral or the normal growth rate of this economy might be 1.75 to 2, and we might be resetting to that. And we're seeing inflation start to really dissipate. Now, before anybody emails me or calls me and says my price of chicken went up, or the cost of tuition for my son or daughter went up. All right, low inflation or even deflation does not mean all prices fall. We can see prices of some goods or services rise even in a deflationary environment, depending on specific supply and demand circumstances, elasticity of demand, and so on. So for something like education, that is a fairly inelastic demand curve. So what happens is prices go up. The users, in this case, to students or their parents, continue to pay the tuition almost irrespective, or with less of an influence, but of higher prices, as it were. What happens is it takes spending out of other areas of the economy, and so it's possible to have inflation on an inelastic part of the economy: tuition, home heating, food. And by the way, this is why food and energy are kind of separated by the Fed, not because they don't count, because they have inelastic demand curves, right? The price goes up, you're not going to cut. You can only cut so much. You have to eat, you have to get to work, and you have to keep warm. So food and energy, there's not too much you can cut back on, right? So what happens is if those prices rise, you could get less demand in other areas of the economy, and that creates disinflation or an extreme deflation, right? Now, it was hoped that when oil prices fell, that we'd have the exact opposite. We'd have cash being freed up from an inelastic part of the economy, fuel, and that would be spent in an elastic part of the economy, retail, and hopefully goods, apparel. And apparel is like one of the main areas economists look at to see if we're seeing an increase in consumer sentiment, consumers' ability to drive the economy. What happened, though, it materialized in restaurants, in leisure and hospitality. That's for a couple of reasons. One, that is the preference right now. We are in a service and media economy. Two, if you're saving, remember, if you're even a mid-size SUV, some of the large SUVs now get 25 miles to the gallon. The small ones will get over 30 miles to the gallon. So when you save X amount on fuel, you're still saving 40% versus last summer. But in raw dollars, instead of saving $50 that you might have when you're driving the big gas guzzler, you're saving $25 because you're burning half as much fuel, right? Still a good benefit. But now, if each week, if you have an extra $20 or $25, or maybe every other week you have an extra $20 or $25 in your pocket, You're probably not going to go out on a spending spree. You're probably not going to remodel your kitchen. You're probably, not going to take a vacation unless it's a small trip. You're probably going to do is go to a movie, increase your connectivity with your mobile device, cell services, internet connectivity. You're going to go to a restaurant, probably a fast casual, right? Red Robin, Chipotle, etc. That's what you're going to do with that little extra savings. And if you look at the retail sales data, if you look at the regional Fed data, if you look at almost every gauge of spending out there, that's where it's materialized. Okay, so it's not going to drive this economy to escape velocity. The economy is at escape velocity. At least this currently structured, and this is the escape we get. Okay. We have the largest segment of investors, well, at least where most of the wealth is held, the boomers and older. Well, when they were in their prime working years, they were in effect borrowers, right? They borrowed to buy a house, a car, credit cards, home equity loans, and they spent. So low rates helped them. Low rates helped to boost spending because it made the cost of capital, even if it was borrowed capital, cheaper. But now, these same consumers who are the largest holders of wealth in the United States are now net lenders. And by that I mean they are buying bonds and other income vehicles. So they are lending money to corporations, municipalities, governments, whatever, and expecting a return of interest. And that's their income, and that's what they're going to spend. So where low interest rates helped this segment of the economy, now it tends to constrain them. So there are a few of us out there, and we kind of get giggled at, even though the evidence is mounting that we are correct. A modest or moderate increase in interest rates might boost consumption. Why? Well, it's not going to take much out of the borrowing part of the economy, at least not among individuals, because slightly higher rates would only hurt those who are less creditworthy or lower incomes. Well, they can't get qualified for mortgages anyway at this point, thanks to very, very strict government oversight. Look at the GE Capital story out there today. Why GE is getting out of GE Capital. The oversight is so arduous that they can't lend. Can't make any money, can't take risk, right? So it happens also on the individual borrower side, right? They're not getting access to credit. But on the other side of the equation are these income-oriented investors, right? If they're getting 1% on their investment vehicle, but if they get 1.5 or 2, it still might not seem like a lot, but hey, that's 50 or 100% increase in your income. It's a big increase, relatively speaking, since they hold most of the wealth, and they're going to keep buying the fixed income items because they cannot afford to lose money. And if you own an actual bond and the issuer remains solvent, you know what you get between the time you purchase at maturity and you know what you get at maturity. You don't do that in other investments, even in other fixed income investments. So it is my opinion that a slight increase in the interest rates might, it's a big M because we've never been here before, might add to consumption, among the average consumer. So, but barring that and barring pro-growth fiscal policies, which I do not see coming out of Washington now or after the next election, there's not a whole lot of impetus for stronger growth and stronger hiring, especially stronger wage growth or inflation. Meanwhile, overseas, we're pulling dead weight. You have China slowing down. Yeah, China's going to still might grow 5 or 6, maybe. But asset prices, commodity prices were priced in for China growing 7, 8, or 9, maybe even 10. So it has to reset. We've said this before. These other economies have never diversified themselves. Europe is a demographic problem. Japan is a demographic problem. So it looks like we're starting to get into the deceleration phase of this economic cycle. However, deceleration, like I said, does not mean contraction, nor does a trough, a bottoming of the business cycle necessarily mean a deep recession. It might not even mean a classical recession. And if we go back to the year 2001, following the tech bubble, we saw the GDP contract in Q1 and Q3 by just over 1% each time of that year. But Q2 of 01 rather, printed positive. We never had a classic recession, and growth picked up quite a bit after that, even before the Fed went to 1%. Now, the big problem then was the jobless recovery. The economy was doing right, but people weren't being hired. There was no wage growth. Ooh, sound familiar, right? So all we had was housing interruptus from 04 into 07. We just resumed the economy we had after 01 or after 2000. This is a long-term trend. So we can blame Bush, we can blame Obama, we can blame the man on the moon. And in truth, both administrations could have done a better job. But the problems are more structural, based on technology, globalization, and demographics. So my base case, and I'm not an economist, I'm just a silly old fixed income strategist, but based on what the bond market is telling me, based on what the economic data is telling me, is that we're entering a deceleration, but that the trough may not be that deep, and we might not even see a classic recession, except if somebody does something stupid. And that could be a bad policy decision by the Fed, a foreign central bank, or elected officials here or overseas, or by not truly freely elected officials like Vlad the Incorrigible in Russia, or the Keystone cops, who aren't elected, running China. Maybe that's a smart leadership, but they're out of their element here. I could put a very smart basketball coach in charge of the Patriots, and even with Tom Brady, he's not going to win many more football games, I don't think, or not be as efficient as Bill Belichick with or without inside knowledge of the other team's playbook. That's another story. So that's where we are in the economic cycle, at least in my opinion. So this comes back to interest rates, and we have investors saying, "Boy, I wish we had interest rates like we had during the 70s or early 80s, because, wow, we got some great returns." But we also had high inflation. And if I look, I can't show this on screen because the compliance will get mad at me. But if you look back in 1976, we had a 10-year yield that was north of 6%. But you had negative real returns. Why? Because in 1976, inflation was about 9 3/4, thereabouts, according to the chart I got from Bloomberg. So you had basically negative 3+% interest rates. So investors were getting, off of the U.S. Treasuries, getting a nice 6% return, but prices were going up faster than their income. So, and we saw that again in 1980-81, and we saw that happen again in 2011, where we actually had inflation run higher than the 10-year U.S. Treasury rate. And remember, I'll say this again, the long end of the U.S. Treasury curve prices always and forever to inflation, not growth. It seems to move with growth because most of the time, but not all of the time, growth and inflation tend to move together. But as we saw in the late 70s, early 80s, when inflation went here, but growth went like that, that doesn't happen. And we've seen over much of the last 2 decades that inflation remained fairly manageable, but growth has been fairly positive, right? So there are times that they do disconnect, and I believe this is a disconnect time too. U.S. economic growth could probably grow between 1.5 and 2.5, depending on, on policy decisions here and abroad. But it doesn't. There's nothing out there that augurs for higher inflation. Now, one firm out there was noting that the spread between inflation, as measured by core CPI, and the 10-year Treasury were abnormally tight, and they are abnormally tight, but not unprecedentedly tight. They've been here before, and their conclusion was that it's the bond market that's wrong, and bond yields will have to go up to adjust for inflation. My view all year long has been bond market's right. Inflation is going to fall away from bond yields, and that's what started to happen. Inflation is starting to now fall away from bond yields. We're starting to see more disinflation and deflation out there. So you know, I think we're in a situation where rates stay low for a long time. Now, and I'm talking about the long end of the curve, but now on the short end of the curve, we have Fed officials who are the group, the Federal Open Market Committee. They're fracturing and they're taking sides. They're the Doves and the Hawks, and the Doves are now becoming more and more adamant that we cannot raise rates because the economy is under too much pressure, mainly from external sources, and we can't raise even 25 basis points in the short end. I disagree, but I don't make policy. The other side is that we are the Hawks who are saying ostensibly we have to raise because inflation might get out of control if we keep rates down too long. Okay, that's theoretically possible, but I've listened to the guys on the Hawkish side for many times. I've even been at a meeting with Richmond Fed President Jeff Lacker down in Philadelphia one time, and I like Lacker. He's like the Hawks hawk, right? But I don't think that he really believes that runaway inflation is a concern now or in the near future. I do think he believes, in spite of what he says publicly, that he thinks that rates might be too low to generate growth. And he also probably wants, and this is probably the Hawks in general, wants some ammunition to be able to reinvigorate the economy in case the emerging world, implodes or at least flatlines. And I think he's right, except that the Fed missed its chance. The Fed probably should have gone up 25 basis points last year. Should have finished tapering early in September, gone up 25 at the December meeting. Waited, gone up 25 at the June meeting, or even probably at the June meeting, and then held the line and start talking dovishly that we could cut again. All right. I think you would have gotten some confidence from the Fed moving. It would have. I think you would have seen the economy pick up over here. But the fear was, if we strengthen the dollar here, it's going to blow up the recovery efforts, the monetary-based recovery efforts in Europe, Japan, and the emerging world. And that's all they have are monetary efforts. There's virtually no shot, in realistic terms, that fiscal policies are going to change to pro-growth, pro-inflation, pro-consumption in those foreign economies. It's not what they're about. Okay? So we could be in an era could be a decade, maybe even longer, where rates stay fairly low. And we're starting to see this low consumption, low inflation, strong dollar scenario play out in corporate earnings. Walmart was one of them today. I don't want to speak too much about individual credits or whatnot, but Walmart definitely felt the impact of a stronger dollar. It felt the impact of of being convinced, for lack of a better word, to raise wages, even though the business results did not warrant it. It lowered its guidance for sales next year, rather, to basically flat, and it lowered its EPS estimates, and it gave an outlook out to 2019 that was less rosy than before. And the market took that to heart. The Dow was down 157 today. The S&P down almost 9.5. And again, we are sitting with the 10-year Treasury yield that at the present time is yielding 1.974. And it trades, till 5 o'clock. Then it'll trade overnight and after hours, overnight trading overseas. All right. So, that the high inflation fear story, or the rising rate story, is kind of like out of bed. And we saw that with the PPI numbers today. We saw that deflation, disinflation is coming home to roost at this point. We saw deflation on the headline reads, and we saw disinflation on the core reads. So even when you backed out food and energy, especially energy, which is down year over year, you still saw the pace of inflation fall. And this comes back to PPI X food and energy. It expanded. Prices went up by about 0.9% outside of when you take out the downward pressure from falling energy prices, right? Last month the prices rose 0.9%. This month only 0.8%. The street was expecting to rise to 1.2%. We're starting to see in the last CPI numbers. If you look at the regional data, out of the four main regions of the country, only the West showed inflation. If you took that out, there was deflation in the other three regions, East, North, South. So, there's really not much inflation pressure out there. And tomorrow we have CPI, and the street's thinking that year over year, core CPI is going to run at 1.8. Now, don't get excited because one, that might not happen. We could see a 1.7 or 1.6 print for all I know, but that's not what the Fed looks at. That has so much rent in there, owner's equivalent rent. It skews the number higher, right? So basically, the Fed wants to see core PCE at around 2, which would put this 2.5, 260, 270. So we are a mile away. We are miles away from seeing inflation get to the point where the Fed doves feel compelled to move. So this is not shaping up to be a banner year for those who were bearish bonds. So what do I see for the rest of the year? If we see 230 on the 10-year, that could be high. We might have a better chance of seeing 180 than 230. So the calls for 3 are just right out. They're just not going to happen. There's an ARB going on overseas. We have traders or even investors, including pension funds and insurance companies and whatnot. They're doing an arbitrage trade out there. So you have the 10-year German Bund sitting at 58 basis points or so. The 10-year Treasury sitting, they call it 197. Well, you could pick up, you could pick up almost 140 basis points, but by moving by investing in the U.S. Treasury, than in the German Bund, you can move up about 160 or so, but versus the Japanese 10-year JGB. So we're attracting a lot of capital because our rates are relatively high. Switzerland is negative out to 10 years. So there's this demand, never mind demographic demand, there's this ARB going on out there, a carry trade, if you will, going on. So there's not a whole lot that's in the markets, in the economies that are going to push long-term rates higher. There's not a whole lot the Fed or other central banks can do to stimulate consumption at this point. The interest rates aren't the problem. The ability to get credit here and the desire to have credit overseas are the problems. And if people aren't making money, they're not working as much because they're not selling commodities. So the Brazilians aren't selling as many barrels of oil or board feet of lumber to the Chinese. Look, it's happened in Australia too, although their economy is more diverse. They're not going to be in a position to borrow and spend. So it comes down to fiscal, it comes down to structural after all. So what I say, again, move up in quality. It won't prevent volatility. It won't stop some of your investments from dropping in price, but the drops will probably be less dramatic than if you're in high-risk assets. Many investors have been pushed into high-risk assets in search of yield. Greg Ip from the Journal has written a book which appears to be excellent. I got to pick up a copy, but I've heard about it. I saw his interview today saying how by trying to moderate the severity of recessions and market corrections, the Fed has essentially made them, or by reducing the frequency of them, I should say, has made them more dramatic, more significant when they occur. And he draws a comparison to what the Forest Service has done when they prevent forest fires. Forest fires occur naturally, as he explained on the interview this morning. It's correct, lightning strikes and whatnot. And what that does, if you let that happen, it clears a lot of the underbrush, and it limits to an extent the scope of a forest fire. But since we have become so good at containing forest fires and eliminating forest fires, when they do happen, and we see this out west every year, there's so much fuel for these fires from our own intervention that the fires are actually more severe. So they're less frequent, but more severe. You can make an argument with the Fed, with what the Fed has done, and it just desensitizes investors to risk. We're way out on the risk curve, and those risk assets were probably priced to outcomes that are unlikely to materialize. So we think we'll see a rolling back, as my pal Bill Malley likes to say, when the tide goes out, we see you swimming naked. I think there are a lot of people swimming naked out there. Some people have gotten out. That was the correction we saw back in August. That was the widening in credit spreads. But based on some of the strategy I read coming out of the firms, and these are from strategy generalists, not from the fixed income side, I'll say that. But there's too much complacency out there, too much hope that the Fed and other central banks can ride to the rescue, and still some sentiment out there which states that the bond market has it wrong. Good luck. And with that, we're a couple minutes over. This weekend in the trenches, I'll be featuring the business cycle, hopefully some nice charts and graphs to illustrate what I spoke about here. So be sure to get that. If you're not a subscriber, we're offering a discount here. We found that many subscribers, many readers like to pay on a monthly basis. Usually it's $25 a month, and that's just not for the newsletter. With the full service bond desk, we'll analyze your portfolios. We'll make suggestions on them. We'll analyze the bonds. We'll here at Bond Squad, we'll go through holdings for any potholes. So basically, we become the desk that you may or may not have at your firm or through your advisor if you're an investor. So the discount is 20% off, so it's $20 a month rather than $25, and you can cancel at any time. Going into year end with so much uncertainty in the market and so many bad calls on interest rates and credits out there, it might be a good idea to at least give us a try at $20 a month, at least through the end of the year. You can cancel at any time. One doesn't want to be penny wise and pound foolish. We had before I go, I had an email from a subscriber, and in my reports for 9 months, I've been highlighting the Fed funds futures. And back at the beginning of the year, when everyone thought the Fed was going to be in tightening mode this year, I went out there and I got criticized for it, saying that I don't think the Fed funds rate will be above 1% by the end of 16. At the time, I think the Fed funds futures for December of 16 was right around 1.01, 1.02, and it was like 1.05 or so for January of 17. Well, now we're well below 1 for the end of 16. In fact, we don't go to over 1% on the Fed funds futures until October of 17, right? So one of my readers wanted to get a copy of want to see that information, and I did send it out a while back, but he didn't want to bother me. So he called the desk at his firm and asked his contact on the desk, his liaison, his coordinator, as it were, for, information on Fed funds futures. And the guy on the other end really didn't understand what he was talking about. He, according to my subscriber, he got some information on it, but he couldn't find all this and what it meant, yada, yada, yada. So what he did, so he emails me, long story short, within 5 minutes, if that, I had Fed funds futures out from the current month out to the end of, out to mid-18, I think, mid-2018 for him. So we provide all that service too. If you want color on the markets, color on the yield curves, color on futures, want us to run relative value, we do that. It's all part of that subscription. For $20 a month, you're getting a fixed income strategist slash portfolio reviewer slash liaison and coordinator, all that works for you, not for a desk, not pushing product. $20 a month, probably not a bad value, considering what a mistake might cost you if you're not aware. So with that, I wish everybody a good evening. Maybe my Mets will move to the next round tomorrow. I was hoping last night. Now I'm a bit nervous, but just a game. Bond market's real life. And with that, have a great night.